Hello, traders from surprisingly sunny Seattle this week. Me, Dan, and Mick are on the road, so we couldn't be here to do a live Coach's Playbook today. But we do have one of our more viewed episodes of all time queued up. It's 3 ways to start strong in your funded account. Hope you enjoyed it. Trade well, and we'll see you next week. Bye. Hello, traders, and welcome to the first episode of the rebooted Coach's Playbook. I'm joined today with every performance coach we could squeeze into the camera frame. We got with us Dan, Hogue, Mick. They all know you, right?
I think so. We've been on here a time or two.
All right, well, today the topic we're going to talk about is how, 3 ways you could start strong in your funded account. But first, Mick, I think you had a few traders you wanted to give a shout out to.
Certainly. Before we get started, big shout out to Ephraim Young, putting up a little over $1,000 in the NASDAQ this week, as well as Blake Huber, too, put up $1,200 in the NASDAQ as well. You guys are killing it. Great job. Can't wait to see more of this action out of you guys.
Yeah, I'm going to go ahead and guess they were long, right?
Yeah.
Okay.
I recognize both those names. Good job, guys.
Yeah, it's pretty awesome. Really excited when you're able to take some money out of the market, which I think is a cool way to kind of introduce the first segment we've got here for the first Coach's Playbook in a while.
Yeah.
Yeah.
All right. Well, anyway,
it feels so good to be back.
All right, the Trading Rat Pack over here. Let's get down to it. Today we're discussing 3 ways traders can start strong in their trading combine.
Absolutely. And I think it's super important when you think about it. You get to that funded level, things change a little bit. It gets a whole new level of psychology, a lot to be thinking about.
It's harder to make those hard decisions, isn't it?
It absolutely
There's
100% is.
Added layers, definitely.
Absolutely. So I think the first point we want to make is starting slow.
That's where I'd start.
Right? Mick, why don't you break that down?
Yeah, you start with that slow response.
So I think with most things, we're talking about funded accounts here and how to be successful. Starting slow is huge. You're experiencing different things from trading simulated to now live. Like most things, start with your toe in the water. Don't dive in head first. You're going to want to think about keeping any losses to a minimal early on. Large losses early on mess with you psychologically. Everybody knows that emotions are tied to that. It can snowball. Start trading one contract too. Get a feel for it. It's just, I think the largest problem I see with traders being unsuccessful is they're the ones that allow themselves to have huge losing days early on. It's too hard to come back from that.
Right, you think about it, you're coming into this account, you're starting from scratch. Yes, you made some money in the trading combine, but now this is realized money. This is a real deal for you. And there's a lot going through your head when you jump into this, and instantly you want to be thinking about how much money can I make? And that can't be the thought process. We have to think about our process, how we're going to execute on this. We have to start step by step. That first $100, that's what we have to make first before we can think about that first 1,000 or 10,000.
Exactly, and like you said, people want to make money. What happens when you do start off on your first day and you lose 1,000? What are you going to be thinking? You're going to be thinking about chasing and making that $1,000 back.
Right.
You're going to potentially be trading a P&L and not what the market's showing you, and it just makes things that much more difficult.
Right. So here's a question for Hogue and Mick. I think you might know best. Do you see traders forcing trades sometimes? Like trading at times that maybe shouldn't be because they have this account?
Yeah.
Yeah, and I think one of the biggest things is they've succeeded in the combine. They've gotten through step 1. They've gotten through step 2. They're getting the funded account. Now it's all about the money, and the change in the account seems to make them change what their ideas are, what their strategy is. And again, it may just be a function of thinking about the money. Starting slow may just be continuing with what got you into the funded account. It's not now about hitting home runs all of a sudden. It's continuing what got you there.
Yeah, I agree, John. Where I see people basically struggling are the people that are down are the ones that are trying to force trades. You feel the need naturally to get that money back, turn things around. I don't know what else you would be thinking. Of course, if you're down, you want to get it back. The people that aren't forcing trades are the people that are positive. They're sitting comfortably They have a certain amount of capital and they're looking to preserve it. They don't need to, take money out of the markets today. They have the ability, and they've earned the ability through profitable trades to kind of be patient and wait for a good one to come their way. And they get to be selective too.
Absolutely. I think that kind of segues really nicely into this next bullet point that we want to touch on, is starting small. Once you start to grow that account, you slow yourself down. You start to recognize what was working, what wasn't. If you can kind of come in with that mentality from day one, just start slow or start small. Meaning, keep it simple. Trading those one lots, like Mick was just saying, thinking about it in that process, it doesn't have to be huge P&Ls. It just needs to be profits and consistency within your process of how you're executing, how you're moving forward, things that have worked for you in the past. Remember, you learn a lot through the trading combine. You don't have to take everything crazy from the past. Try it again new in the funded account.
Yeah, one other thing about starting small is I personally like seeing traders that consistently put up small numbers on a day regularly. Make $100 4 days out of the week, or average $100 4 days out of the week. Those people that start small, they have a much easier time growing, and they're going to do far better than the people that make 2,000 one day, lose 2,000 another day, make 1,000, lose 1,000. Because at the end of the week, you can have big swings, but it doesn't add up to anything if you're risking just as much as you're willing to make. It's those people that, may have four $100 winning days, and people scoff at that all the time, but it's like at the end of the week, you have $400 you didn't have the week before. And that's your job as a trader, to have more money in your account this week than you did last week.
Right, and I think it's a great way of looking at it, and also realizing that if you kind of continue to just chip away these little $100 days, $100 trades, if you can continue to chip away like that, you're going to be there when that big move comes that allows you to make money like those two traders were talking about at the beginning.
And those small wins, not only are they building your account, but another huge thing they're building.
Confidence?
Bingo.
Bam. Nailed
I
it.
knew I could count on you,
Word of the
John.
day, confidence. Put it up there.
Right, it's adding to your account every chance you get, every day you can, is just basically buying time to build that confidence and to
Bingo.
be there when those bigger opportunities are available to you.
Well, what was always impressed upon me is that if you're not making money trading one lots, you're not going to make money trading 10 lots. That is, it just comes down to that.
It sounds so simple.
Yes.
Yeah.
If anything, it kind of exponentially takes off from there because you
Yes.
start adding.
Right, you created a confidence in a system, and you weren't putting up crazy amounts of risk.
And the bad thing about jumping straight to a 10 lot is if you actually have a really big successful day, it's going to hurt when it's gone.
Right,
Yeah.
because then you're going to start to go, the market's going to start to go against, you're going to remember that one time you threw 10 on when you were always trading one, and it worked for you, and then it's going to hurt you the next 5 or 6 times, but you're always going to remember the one time it paid out. You're never going to remember the time it hurt you.
No, of course.
We got a question coming in here from Level 2 Trading.
Hey, level 2.
Hello. What are your views on expectancy and efficiency? Use of your risk management. Leverage.
So, views and expectations. Oh, so if you, to just get a better understanding of this question, basically, if you have created expectancy and you've created an efficiency within your system and adding that leverage, I think that's where you've already created that consistency and profitability. Once you've gotten to that point, then you can start to leverage up.
Yeah, I think that's the one time you do want to leverage up. I mean, I'll basically say I think when you're consistently profitable, that's when you can easily and safely justify trading a little bit larger. I'm consistently profitable over 3 weeks. Okay, I'm going to up my contract size. Oh, I have a bad week. Well, I bring it back. But when you're consistently profitable, you're able to justify the larger size. And consistently profitable on a weekly basis, it doesn't matter if it's $50 a week or $5,000 a week. Profitability is profitability.
Right, if it's green, it's good.
Yeah.
Absolutely. So we all agree, start small. That's number 2. Segues nicely is the third point we have on here. It's pretty self-explanatory. You got to have a plan.
Absolutely. I've been harping on this a lot lately, and it's this concept of having the process, focusing on process versus the outcome. If you can create consistency within your process based off of your trading plan, the profitable outcome's going to eventually be there. But if you can focus on process, know exactly what you're looking for before you even sit down to think about executing a trade. You know that if the market gets to this point, here's what I'm going to do. If the market goes this direction, here's what I'm going to do. You've got a plan, and you can sit down, write that plan out, and know exactly what you're going to do. There's no hesitation once the market gets there.
This might be a little harsh, but I have two hard realities. If you do not have a plan and you're trading in the markets, you're flailing. And if you're flailing, you are going to fail. And if you don't have a plan, there's nothing keeping you disciplined. And if you are undisciplined in the markets, you will be unsuccessful. These are realities. If you guys could prove me wrong, feel free.
No, I think it goes to the old adage: if you fail to plan, you plan to fail.
Yes,
Yeah.
that's right.
Bonus, we got a Hogue shout out here from Level 2. It says, by the way, I got a sweet buy on the oil at $56.95.
I planned the trade and traded the plan.
Nice
Ties
job.
in nicely.
Yeah, why are you watching this? You got this set. Let's just do this whole thing on mixed two harsh realities.
Absolutely. No, when you have a plan, you have at least the opportunity to bring consistency to your trading. If you don't have a plan, you're like Mick says, you're going to be kind of flailing. You're going to be jumping at shiny things. And something that I talk to traders all the time about is, yes, you want consistency, but you're not willing to do the work to bring that consistency to the table. Once you find that consistency, you can find your hypotheses, you can find your scenarios, you can trade to those scenarios when the market gives you that opportunity, right?
Yeah, exactly. If you have a plan, you can see what's working and what's not working. And when things are working, you leverage them. When things aren't working, you change them.
Scale it back, slow things down, get back to the basics. I mean, I can count countless times where I felt really good, things started to go against me, and just simplifying every process that I'm doing, every little thing I'm thinking, getting back to what's this market telling me versus what am I expecting from this market. And I think that's what it's all about, making sure when your plan is working, you stick to it. When you start to recognize things are off, pull yourself away from that market, start to adjust, recognize what's off within the plan. Is it the plan? Is it me? Am I not executing properly as my plan states? Maybe I'm getting excited. Maybe I've had some great winning days, or I've had some losses that kind of kill the confidence within that system that has been working so well.
Yeah, the really great traders that I knew that eventually blew stuff up, it was because they would never scale back. It's once they got to that size, it was like, this is the size I trade,
Right.
and to hell with it. I'm going bigger. I'm going home.
Right, I think that's a great point.
You've got to be.
And they mostly went home.
Yeah, you have to nimble and flexibility on your own performance, but also market environments too. Those are always changing. Lower volatility, you can trade a little bit larger. When you start seeing larger ranges and faster movements, maybe you're a 10-lot trader, maybe you scale it back to 4 contracts. So,
But I think that goes a lot to what Level 2 was talking about is, how do you scale according to the risk? Your leverage on more volatile days, you probably don't need as much leverage for a big profitable trade, right?
Absolutely.
I agree.
Things go crazy. Level back a little bit, size back a little bit, because you're probably going to need to take more risk per trade, and the opportunities for profit are likely to be much greater in volatile times.
Absolutely. And by the way, those of you that are watching, don't hesitate to drop any questions or thoughts in as we continue to go through this and all the coaches' playbooks that will follow up here.
Well, one thing I wanted to point out is that this is the first rebooted episode. We're kind of doing the same thing here. We're starting small. I think we got like 11 people, 12 people now, 13 people now watching.
Lucky 13.
Starting small, and then you got to scale that up. You get your 100,000. You get put on CBS primetime or something like that.
Absolutely. Looks like we got a quick question here from Ezekiel. Hey, Ezekiel, how are you?
Zeke.
You think scaling back is better than having trailing stops? John, why don't you dive into that
Oh
one?
man, trailing stops for day traders are an art form. I don't know many people who have mastered them. Trailing stops to me are kind of more of a longer term or an investment type of play. Trailing stops, are great in directional markets. If you've found a trending day, trailing stops can help keep you in that market until there's an actual break in that trend. Range days, I try not to move my stops at all. I know my point of invalidation, I know my profit target, and I'm going to leave it there. So when it comes to trailing stops, it's a market state thing for me. In a trend, I'll look for levels where that trend may break, and then I'm going to trail that stop a little bit further than that, because I see traders all the time. It happens to me. I'm sure it happens to everybody, where you've got a nice runner on, you've got a nice trade in a trending market. You pull that stop up a little bit too close, it comes and finds that stop and leaves you out of the trade.
Yeah,
absolutely.
John mentions it's a market state thing. I agree with that. I also think it's a time frame thing too. Depending on what time frame you're trading on, short time frame scalping, it's never a bad thing to limit your risk by moving your stop, whether it's an automated trail of the stop or a manual move. But even when you're scalping, and especially moving into a little bit higher time frame holdings, you need to give the market room to breathe. Take a look at any chart, whether it's a 5-minute chart, a 15-minute, or a 60-minute chart. What do you see on each one of these bars? We have tons of price bar overlap. Mm-hmm. You could be dead right, but you could tighten that stop up and not let that market breathe. You get taken out of a trade, and odds are you get taken out of it right before it goes sailing in the direction you wanted it to go in.
Talking to as many traders as I've talked to, at least 50 to 60% of them, one of the things they talk about is, I find a good level, I get in, the market starts to go my way, I like to move my stop up to break even, or break even +1, which is a form of trailing the stop. Basically, all you're doing is paying for the trade at +1, right? Or at least alleviating the risk on the trade. But how many times have I had traders say, the market will come back, hit my stop, and then the trade will play without me. It'll play out just as I expected. Well, you didn't let the trade breathe, like Mick was saying.
Breathe.
Yeah. Breathe. And we'll say hello to Matthew F. is there. Says hello, guys.
Matthew.
Right, and one thing I wanted to just add on to that really quick is something that was taught to me a long time ago is looking at the market as though it is as a heartbeat. It's going to go, it's going to bounce, and it's going to move, and you just have to start to learn that rhythm, getting used to the movement of that market, and then you'll start to be able to say, hey, look, I've recognized that I'm watching this market continuously over time, and maybe you've kind of created some sort of instinct to where you can bring that stop up. So I'm very cautious of trailing that stop until I understand the market and have those defined levels in play.
Just making sure I still have a
Yeah, absolutely. Well, I think it's about time to close out. There's a few questions that I think we can answer best offline here.
Okay.
Don't think we forgot about you guys, but just to bring everything back in conclusion, our 3 ways to start strong in your funded account was to start slow, start small, and have a plan.
Yep. And lastly, one thing we're going to do regularly on this is kind of bring in a quote and as it relates to the segment and to trading in general. So today we've got one from, sorry, the color is not ideal there, but it's a quote from Babe Ruth. Don't take my notes. Yesterday's home runs
I'm trying to move those so you can see.
don't win games today. So yesterday's home runs don't win games today from Babe Ruth. I think it kind of ties in here really nicely, basically saying don't let your wins yesterday dictate how you're going to play today. It's all about those singles and doubles, getting on base and moving forward.
I can't tell you how perfect this quote is because it does translate. One of the biggest oopsies is people that don't follow that.
Well, on that note, that's some great advice from the Bambino. I think we'll try and do this again next week. So if you were here, come back. We'll squeeze in here again. All right. So signing off for the Coach's Playbook. Good night.
Trade well.